Want more of the Josh Scanlon podcast?
Please.
Here you go. The Josh Scanlon podcast starts right now. Welcome to the Josh Scanlon podcast, my friends. It is Wednesday, February 6th, 2019, and we're going to have an exciting podcast here for you today. I'm going to talk about the three most important financial planning concepts, and I'm going to read you the articles from which they came. Incredibly important. One from the 90s, one from the aughts, and one from just this past few years. I'm telling you, I did a YouTube video on how you should become your own financial advisor. For yourself, but also part two of that to help other people as well. So they can get their affairs in order without charging them 1% of assets under management and all that crap. I hate that stuff. But you got to know these three things. The three things, most importantly, got to understand. And we're going to dive into that in, again, three different articles. So as always, if you like what you see here, if you're on the podcast or if you're on YouTube, subscribe, thumbs up, comments, give me a review on whatever iTunes or Stitcher or whatever, the anchor.com.fm, anchor.fm. All right, so let's go into this. The old days of financial planning, first and foremost, was we look back, we used the Ibsen charts and whatnot, and we say, oh, stocks are dwarf bonds, blah, blah, blah. That's where we got the Dow 20,000 thing from a guy named James Glassman towards the end of the 90s. And everyone's like, when that didn't happen, they all said, James Glassman was an idiot, blah, blah, blah. And he was proven correct because he's looking at what's called the risk premium stocks versus bonds. And the basis of this was stocks give you 10, bonds give you 6. Thus, there's a 4% risk premium. And if you can extrapolate that, we can get a Dow 20,000. I don't want to get too deep into that because Glass was actually proven correct. It wasn't the way he anticipated. But the basis of that was stocks give you 10% on a linear basis each and every year, 10%. And so in the old days of financial planning, financial plans are based on that theory that, I'm getting 10% a year. Linear, that means I can pull 9% a year without even tapping my principal. It made sense, because 10% a year is what stocks gave me. I can pull 9% a year and I'm still adding to my capital and I'm not even touching principal. Well, and then a guy in 1994 named Bill Bengen came up with a 4% rule. And this was the number one rule in financial planning of the three we're going to talk about. And so I'm going to read you from Bill Bengen's article. I think it's from the Journal of Financial. I can't remember where he had written it initially. Maybe it was probably the Journal of Financial Planning, actually. I forgot. But anyway, we're going to read you the article in its entirety, all right? And then you'll get a gauge of where we are today relative to how this was literally fundamentally life-changing for financial planner. All right, so here's Bill Bengen, and if you look at this article, I'll put a link in the show notes. You see it's definitely the big old glasses, Hillary Clinton style. If you know what I'm talking about, mustache, it's just kind of funny how we used to dress up back in the day. All right, so here we're going to start with the headline. So here's the headline: Determining Withdrawal Rates Using Historical Data by Bill Bengen. At the onset of retirement, investment advisors make crucial recommendations to clients concerning asset allocation, as well as dollar amounts they can safely withdraw annually, so clients will not outlive their money. This article utilizes historical investment data as a rational basis for these recommendations. It employs graphical interpretation of the data to determine the maximum safe withdrawal rate. I'm telling you, folks, SWR, your safe withdrawal rate, and Bengen is going to an M, the maximum safe withdrawal rate, as a percentage of the initial portfolio value, and establishes a range of stock and bond asset allocations that's optimal for virtually all retirement portfolios. Finally, it provides guidance on mid-retirement changes in asset allocation withdrawal rate. And so Bengen, again, this is written in 1994. So Bengen says, the year is 2004. You've done a credible job of building your financial planning practice over the last 10 years. Your retirement clients are particularly well satisfied. You have demonstrated to them the virtue of a diversified portfolio of investments to provide income during retirement. The markets have been kind, if not overly generous. Your clients' portfolios have enjoyed returns well in excess of bank deposits at the bank, on savings accounts and CDs. They perceive you as enriching their lives, and they are grateful. It is 2006. The markets have turned sour as a weak Federal Reserve Board has allowed inflation to spiral out of control. The market is down 35% over the last 2 years, the worst losses since 1973 and 1974. Now, remember, this is written in 1994, so Bengen did not know what was going to happen in 2001 and 2 and 3. Many of your clients are alarmed, worried that they'll have to cut back on their lifestyles to preserve capital in their retirement. You soothe them, reminding that you are carefully computed the rates of withdrawal based on average returns experienced by the markets over the years, and that the markets will recover. However, you cannot help feeling a gnawing concern that you have overlooked something. Fast forward to 2009. True to your forecast, the market has recovered nicely during the last 3 years, and most clients' portfolios have regained almost all their lost nominal value. However, your clients have a new complaint. They cannot live on the withdrawals they've been making. Inflation, averaging 8% over the last 5 years, has so eroded their purchasing power that they must substantially increase their withdrawals or face a drastically reduced quality of life. When you compute the effect on your clients' portfolios at these much higher levels of withdrawals, you are shocked. Many clients will deplete their assets in less than 10 years, even though in many cases their life expectancies are much longer. You have very bad news to tell them. What could have gone wrong? The above scenario is fiction, of course, but it could have easily played out several times during the century. The logical fallacy is that our hypothetical planner in trouble. The logical fallacy that got our hypothetical planner in trouble was assuming average returns and average inflation are sound basis for computing how much a client can safely withdraw from a portfolio. As Larry Beerworth pointed out in his excellent article in the 1994 issue, Investing for Retirement Using the Past to Model the Future, it pays to look not just at the averages, but what has actually happened year by year to investment returns and inflation in the past. He demonstrated the long-term effects of certain financial catastrophes, such as the Depression of 1973, the Great Depression, or the 73 and 74 recession can overwhelm the averages. Such events cannot be ignored, and the client should be made aware of them. In this article, I will build on Beerworth's work, approaching it from a slightly different tact. Using the concept of portfolio longevity, I will present simple techniques planners can use immediately in their practice in advising clients how much they can safely withdraw from their portfolio. I will also explore the issue of asset allocation during retirement, including some surprising conclusions. In all cases, I'll rely on the actual historical performance of the Ibbotson Associates Stocks, Bonds, Bills, and Inflation 1992 yearbook. So remember, Roger Ibbotson. Now, we've talked about him on many occasions here at the Heritage Wealth Planning YouTube channel and the podcast. And he's been running this chart for years and years and years that everyone has looked at and said, oh, stocks dwarf bonds. Thus, my risk premium stocks should give me a significant rate of return in the overall scheme of things. Hold on just a second, folks. I had to open up a window there so I could see outside. All right. So the averages. To begin with, let's see how our hypothetical planner got into trouble to begin with. By referring to the Ibbotson data, our planner learned that common stocks had returned 10.3% compounded over the years, and intermediate treasuries had returned 5.1%. Inflation averaged 3% over the same period. Therefore, a client with a portfolio consisting of 60% stocks and 40% bonds can expect an average compounded return of 8.2% a year, assuming rebalancing. The real return adjusted for inflation would be almost 5.1%. The planner's clients wanted to spend as much as possible each year from their retirement accounts while maintaining a consistent lifestyle. Given the above analysis, it seemed to the planner that the clients could safely withdraw all the real return each year, about 5%, and leave the remainder in the portfolio. The clients could thus increase their withdrawals each year by 3%, keeping pace with inflation. At the same time, the value of the portfolio would increase with inflation, satisfying their secondary goal of leaving wealth for the heirs. Thus, the planner recommended his clients withdraw 5% of their portfolio's initial value at the end of the year and annually increase it by 3%, the anticipated rate of inflation. This plan worked for several years. Hold on just a second. This plan worked for several years as investment returns and inflation stayed close to historical averages. The circumstance that upset the arrangement was an event consisting of a severe stock market downturn and high inflation. What similar events have actually occurred in the past? In Table 1, they list the three biggest stock market declines, and we're going to talk about the Big Bang of 1973 and 1974. Total return for stocks was 37.2% in the red, Total return from intermediate bonds was 10.6% in the black. Change of inflation is 22.1. So total return in intermediate bonds was half the rate of inflation, and total return for stocks was after inflation was about 50%. The Big Dipper from 1937 and 1941, stocks were down 33 and a third all told, and bonds were up 16.7, and inflation was up 10.5. So basically, you had almost a 45% real decline in stocks and only a 6% real increase in bonds. The Little Dipper from 29 to 31, stocks were down 61%, whereas inflation was actually down 15.8, thus a depression. All right, not inflation, not deflation, depression, and bonds are up 10.5. So basically, bonds gave you a real return of 25, basically 26%, and stocks gave you a real return of negative about 45, 46% or so. All right, so let's keep going. The Big Bang of the 1973-74 was the most devastating because it occurred during a period of high inflation. Not only did investors suffer large paper losses in their stocks, but the purchasing power of what remained was reduced substantially as well. It was a frightening period for investors, man, 100%, because remember, even though the bonds in the Big Bang were up 10.6, the fact that inflation was actually 22.1 meant you lost half of your purchase. I mean, you lost. It was a 50% decline in your real return for bonds, because bonds only kept up with half the rate of inflation. And of course, stocks are down 37%, which is essentially a 50% real return decline in stocks. Ooh, yeah. There have been other events of shorter duration, such as 1946, but the above represent the most significant financial cataclysms of the last 3 quarters of the century. Again, remember, this is written in 1994. As planners, we know that such events are likely to recur in the future, as we can certainly attest to, but just how detrimental have these been on the long-term performance of a retirement portfolio? He talks about a series of graphs illustrates the historical performance of 50% intermediate treasury bonds and 50% common stocks, the S&P 500. I've quantified portfolio performance in terms of portfolio longevity, how long the portfolio would last before all of its investments have been exhausted by withdrawals. This is an intuitive approach that's easy to explain to my clients whose primary goal is making it through their retirement without running out of money. The graphs themselves offer rapid comparisons between many different investment scenarios. I've made several assumptions in preparing these graphs. Okay, so I'm not going to show the graphs. At the end of the day, what we're trying to accomplish is Bengen is saying, look, if we did this, what would it look like? And being that is a 50% stocks, which is the S&P 500, 50% bonds, which is intermediate treasury bonds. All right, so that's government treasury bonds, basically 15 years, probably 10 to 15 years. All right, so let's go see. Beginning with, hold on a second, hold on, I want to see what he says. Give the data expert, how do we got our clients a bit? Okay, it's clear from a figure 1 that an absolute safe, to the extent history is a guide, initial level is 3%, and that ensures that the portfolio longevity is never less than 50 years. That is also true with withdrawal rates as high as approximately 3.5%. However, most clients would find such a low level of withdrawals unacceptable. Assuming a minimum requirement of 30 years of portfolio longevity, a first-year withdrawal of 4%, followed by inflation adjustment withdrawals in subsequent years, should be safe. In the past case, it has caused in no past case has a portfolio been exhausted before 33 years, and in most cases, it will lead to a portfolio lasting as long as 50 years or above. By comparison, a 4.25% first-year withdrawal rate could exhaust a portfolio in as little as 2.28 years, were past conditions to repeat themselves. Therefore, I counsel my clients to withdraw at no more than 4% during the first early years of retirement, especially if they retire early, age 60 or younger, assuming they have normal life expectancies that they should live around 25 to 30 years. If they wish to leave some wealth to the heirs, their expected portfolio lives should hold on a second. Their expected portfolio lives should be somewhat longer than that. And so basically they're saying the longer you expect to live, the less you should withdraw. What if a client feels required for larger withdrawals? For example, all right, hold on just a second, my friends. Got a call coming in. We're going to pause this for just. All right, sorry about that, my friends. My wife was calling. So anytime your wife calls, you always got to pause the button to take that call for sure. All right. All right, so what if a client feels he requires larger withdrawals? For example, a client with a $400,000 portfolio would like to withdraw $24,000 the first year, then increase it with inflation each year after that. This is a 6% withdrawal rate for the first year. I show the client let's see, did I show the client and explain the risk of such an approach, assuming that the client now has a 50 stock to bond allocation. If the client expects to live another 30 years, I point out the chart shows 31 scenario years in which he would outlive his assets and only 20 in which he would have been adequate for his purposes. As we shall see later, a different asset allocation would improve this, but it would still be uncomfortable in my opinion. This means he has a less than 40% chance to successfully negotiate retirement. If the client suggests that he can prune back his lifestyle to accommodate a major event, should it happen, I make sure he knows how severe a pruning may be. Even that, it might be too late. In addition, I point out that in most cases, even if he is outlived by his money, there may be little left to pass on to heirs. If this is a significant consideration to the client, it may cause him to look at a more conservative drawdown, at least in the beginning stages of the retirement. I could not agree with that more. Initial asset allocation. Note that my conclusions above were based on the assumptions of a 50-50 portfolio. Again, 50% stocks and bonds, 50% stocks, the S&P 500, and 50% intermediate treasury bonds. What effect would happen with other asset allocations? Would a higher percentage of stocks, given the higher rate of return, be beneficial? At first look at the problem, the chart was created by producing 40 graphs similar to those in blah, blah, blah. We're just going to look at this. Obviously, you can't see that. All permeations of these elements were computed as graphs in the shortest book. Okay, blah, blah, blah. One pattern that leaps out from the figure is that holding too few stocks does more harm than holding too many stocks. The 0% stocks bar and 25% stocks bar are consistently shorter than the others, confirming what we already know. The superior returns of stocks versus bonds are essential to maximize the benefit from a portfolio. Too few stocks in a portfolio shortens the minimum portfolio life. That's, man, all there is to it. Perhaps even more important is the observation that the 50-50 stock bond mix appears to be near optimum for generating the highest minimum portfolio longevity for any withdrawal scheme. This is particularly clear in the 4%, 5%, and 6% withdrawal ranges, which are peaked like roofs at the 50% stock level. So basically, 50-50 is kind of the benchmark where we're shooting for. No, we're not shooting for 100% stocks, not shooting for 100% bonds. We're going to start with 50-50. Does this mean that a 50-50 mix is optimal for all situations? No, not at all. For 50% stocks and 70% stocks, while 50% stocks and 70% stocks are very close, the perspective of the highest minimum portfolio longevity means that you give up very little by increasing your stocks from 50 to 75%, but do you gain anything in return? Clearly, the heavier weighting in stocks has produced some significantly improvements, some fairly significant improvements. Fully 47% scenario times and portfolio longevities of the maximum 50 years, while only 40 years attained the pinnacle in the early part. The only pinnacles occurred in 1966. So basically what it's saying is, it's possible that a stock allocation as high as 75% is superior than a 50% allocation. And before we accept that conclusion, let's perform one more comparison. Let's see where we're going here. Sorting this out, I think it's appropriate to advise the client to accept a stock allocation at 75% as possible, and in no case less than 50%. So what Bill is saying here, at the end of the day, the 75% is optimal if you can deal with the risk, but in no cases should you have less than 50. Stock allocations lower than 50% are counterproductive in that they lower the amount of accumulated wealth as well as lowering the minimum portfolio longevity. Somewhere between 50% and 75% is a client's comfort zone. An asset allocation as high as 75% in stocks during retirement seems to fly in the face of conventional wisdom, but the charts do not lie. They tell their story very plainly. What occurs when we increase stocks to more than 75% of the time is that this turns out to also be counterproductive because we're getting killed when the markets fall. We begin retirement, therefore, with an allocation between 50 and 75% stocks. I assume 75% in the discussion below. All right. Do we maintain it during all of retirement? My research indicates strongly that as long as the client goal remains the same, there's no need to change the initial allocation. It is likely we do more harm than good if we do change it. Let us consider first a case where there is a change in the client goals. In this paper, our client's primary goal has been to make the money last throughout retirement. The second goal of maximizing the accumulation for wealth for heirs. The first goal is satisfied primarily by the selection of the initial allocation by making sure you don't run out of money. Consider a client age 92 and in poor health who expects to live at most a few more years. Assume that her retirement assets are more than adequate to last for this period of time. Even if invested in relatively low-yielding bank CDs, if her primary concern has shifted to leaving maximum wealth to her heirs, a case could be made for selling all of her stocks and converting to CDs. Note that we're assuming that all retirement assets are held in taxable tax-deferred accounts. You got it, man. That is 100% right. 100% right. All are in tax-deferred accounts. We're not taking into consideration taxes, and we're not considering fees either. Let's return now to clients who are well in retirement, perhaps 10 to 15 years, but are still concerned about the longevity of their portfolio, which must support them for another 15 years. For this analysis, I divide them into three asset classes: those whose investment results have been exceptional, those who have earned about what they expected, and those by virtue of an event occurring have gotten the black holes. The black hole group is a very uncomfortable situation. As an example, the client who retired in 1929 with $500,000 saw that fund dwindle to $200,000 by the end of 1932. Although his withdrawals have also declined from $20,000 to $15,000 owing to deflation, those withdrawals now equal about 7.6% of his portfolio, whereas begun by only withdrawing 4%. In this situation, with stocks having performed so dismally so early in retirement, it may be tempting to switch all investments to bonds in order to salvage what is left. That would be precisely the wrong thing to do. Let us say that on December 1932, after years of withering returns on stocks, our black hole client demands we reduce his portfolio percentage by stocks. If we eliminate stocks completely, investing only in intermediate bonds, his money will be gone in 17 more years. If we invest 25% in stocks, the money will last until 1950, 50% in stocks until 1957. And if we had 75% of stocks, it would have lasted until 1992 and had $1.7 million. All right, so that's there you go. Once you get hit on the back end, on the front end, it's very, very problematic to go to bonds at that point. The damage has already been done. But what if our client had the audacity in December 1932 that we increase the stock allocation 100% and hold that for the remainder of his life? Despite suffering through the Big Bang and the Big Dipper, by 1992, if he were still alive, he would have amassed $42 million. That's just luck. It's just luck. No other way around that. All right. So, and I want to read all this stuff. At the end of the day, what Bengen is saying, I just think this is so. Let's just read his conclusion here. For a client just beginning retirement, determine a safe withdrawal rate. Do so by computing the shortest portfolio life acceptable to the client. Next, use a 50-50 stock bond allocation to determine the highest withdrawal rate that satisfies the desired minimum portfolio life. For a client who's between 60 and 65, that should be about 4%. The withdrawal rate dollar amount for the first year will be adjusted up or down for inflation every subsequent year. After the first year, the withdrawal rate is no longer used for computing the annual amount. That will be computed instead from last year's withdrawal plus an inflation factor. Should a client wish higher levels of initial withdrawal, he or she would be apprised of the risks. All right. Despite advice you might have heard the contrary, the historical record supports an allocation between 50 to 75% stocks has been the best for a client. For most clients, it can be maintained throughout retirement, essentially not run out of money. Very conservative clients may have difficulty accepting a 75% stock allocation. But using the charts, you can review with them the performance difference between a 50% stock allocation and 75% stock allocation and make them make the choice. A negative feature of the higher stock allocation is reduced portfolio longevity in an era like the Depression-like event or 2001 and 2. A major positive is a vastly increased wealth that will accrue during their retirement and lead to the heirs. All right, with respect to their investment experience, retirement clients fall into three groups. Star clients who earn high returns for extended period of time. They must be counseled not to increase withdrawals excessively or be too aggressive. Then you got black hole clients who experience a major unpleasant financial event early in their retirement, and they may become too conservative, and they should be counseled not to get too conservative. And then you got the middle of the road people who got what they expected. Asteroid clients who experienced average results over the first 10 years probably will not request and should not be recommended a change in either allocation. All right. So that's the epilogue. Here it is. It's the year 2014. A strong Federal Reserve Board under new leadership has brought inflation under control, and the markets have enjoyed a multi-year boom. Your old clients' fortunes have been restored, and they're enjoying their retirement once again. And you heave a mental sigh of relief because the outcome could have been vastly different. You've been planning for new clients using the methods described above, and it's very comforting to know that regardless of what may occur in the future, your clients will survive. Their retirement is not depending on the Fed or interest rates or the vicissitudes of the markets. You prepare them to survive the worst should it occur. Well, maybe. I don't know. Just because that was what it did in 1994 with a 4% rule have still maintained itself in 2001 and 2. I don't know. But now we got the safe withdrawal rate about 3.2. But anyway, so that's number one. All right, my friends. So number one when it comes to financial planning is you got to understand the 4% rule and from where it came. All right, so Bill Bengen, 4% rule was roughly 60-40 stocks to bonds. The 60 stocks are the S&P 500. The 40 bonds is intermediate government bonds. That was before diversification of small international corporate bonds and whatnot. Absolutely. But again, that was when the interest rates are much higher than they are today. And his rule was, hey, if you take 4% on the first year and adjust it with 3% inflation every year thereafter, that is a safe withdrawal rate that you never run out of money. And that's what you got to know, number one. Now, we're going to go into the next article by my man Ty Bernicki, which talked about reality retirement spending. Man, I love this. This is from 2005 in the Journal for Financial Planning. So I'll use that in a second article here. Ty Bernicki's Reality Retirement Spending is the second seminal piece on retirement and financial planning that all good financial planners need to be aware of and know like the back of their hand in order to be an advocate for their clients' retirement planning for sure. So don't forget to subscribe. As always, let me know what you think, and we'll see you next time on the YouTube channel, Heritage Wealth Planning, and of course on the podcast as well. Thanks, guys.